Good morning, everyone, and welcome to Headline Money's Investments Masterclass in association with Schroders. We're pleased to welcome Paul Lamacroft, Head of Private Equity Business Services at Schroders, Uzo Ekru, UK Small and Mid-Cap Analyst at Schroders British Opportunities Trust, and James Lowe, Investment Trust Business Development Manager at Schroders. Paul, James, and Uzo will be discussing public-private equity investment and why this could be an interesting opportunity for investors. For those that don't know me, I'm Michael Cleckhorn and I'm the content manager at Headline Money. And before I hand over to our speakers, I'll just quickly go through how this webinar will run. The session will be an hour in total, and first we'll hear from James, who will then hand over to Paul and Uzo, and then we'll open up the floor to any questions. As there are quite a few journalists on the call, you are all muted and your video is off, but we do want to hear from you, so please use the Q&A button in the chat and we will answer any questions at the bottom, at the end of the webinar. So finally, if you'd like to tweet, our hashtag is HMMasterclass. And I'll hand over to James now.
Thank you very much indeed. And thank you everyone for dialing in this morning for this webinar. And thanks to Headline Money for hosting. We really do appreciate it. Just a couple of introductions. So I'm James Lowe. I look after sales for the Schroder Investment Trust business. Very pleased to be joined by my colleagues Uzo and Paul on the line from different parts of the Schroders business actually. So we've got Uzo works on the public side of our investment equities business, and Paul is on the private side. And it will become very, very clear over time why we have both on the line. I just thought before we get into the presentation, it'd be worth sort of taking a step back and giving a couple of the reasons as to why we're here presenting to you today and why we released the white paper that we released last week on the benefits of a public-private investment approach. So as I say, taking a step back, as we all know, public equities have long been a staple in many investor portfolios. On the private equity side, it's not been such a staple for most investors and largely more into institutional high net worth and private bank portfolios. But in recent times, a trend we've seen reversing really, and we've seen over the last couple of years, private companies staying private for longer, and also particularly in the last year, more public companies being taken private. Therefore, for our investors, in terms of access to these companies, it's become really clear to us that it's been more and more important now to give investors access across the full spectrum, a fuller universe across public and private equities, in order for them to benefit from the full growth cycle of these companies. And I guess that's the really critical point here. It's with private companies staying private for longer, it's how do we access the full growth cycle of companies through the private stage and into the public stage. Now at Schroders, as you may all be aware, we've got a long heritage in active investment management in the public side of equity. But more recently in 2017, Schroders acquired a private equity business called Advec, which now makes up the private equity arm of the Schroders Capital business. And very particularly interestingly, since taking on that acquisition, the integration between the public and private sides of the business has been getting closer and closer and closer. And what we've been finding over the last couple of years in particular is that there's a number of synergies that become available when you have that both public and private side working together in tandem. So I guess that's really one of the main reasons why we wrote the white paper we released last week and why we're here today. So I'll hand you over in first instance to Paul and Uzo, who are going to take you through some of those synergies and why we feel there are some significant benefits in combining a public and private approach. I would really encourage you to ask as many questions as you can, and we'll go through them at the end. Thanks. Paul, Uzo, over to you.
Thank you very much. Next slide. Yeah, thank you. So hello, everyone, and welcome to our seminar this morning. Today, Paul and I are going to explain why at Schroders, we believe that the public-private approach is truly a new paradigm in investing. But firstly, what do we mean when we say public-private investing? Well, simply put, it's an investment strategy that combines both public and private securities in the same portfolio. And in this case, we are talking specifically about public and private equity. So I'll now just hand over to Paul for the next slides to discuss why we believe that there is such a need for something like this in the first place. Paul?
Great, thanks Uzo, and good morning everyone. So just to pick up on why we believe there's a real need to combine public with private assets. Increasingly, I think over the last few years, the lines have becoming more blurred between what is a public and what is a private company. These companies are becoming much more alike over the recent past. And when James picked up on the private companies staying private for longer, that's a key element of this. The amount of capital that's able to flow into private capitals these days means that they have the option to remain private for far longer than they have done historically. And one good example of a business that's done exactly that is Uber, that was founded back in 2009. Many of you will be very familiar with Uber. That IPO'd 10 years later, so in 2019, and it IPO'd at a $70 billion valuation. So by missing out on access to these private companies, you're missing out on the potential value growth of companies such as Uber that have grown to significant scale over a relatively short period of time, over 10 years. And grown to $70 billion worth of value. So incorporating private with public seems to make a huge amount of sense. On the right-hand side of this slide, we talk about private equity having limited lifetimes. Typically, if you're looking at private equity standalone, private equity funds will look to exit their investments at or shortly after IPO. So again, this misses out potential on significant value that can grow beyond the IPO. And a good example of a business here is Google. Google, again, everyone will be very familiar with, founded in 1998 and IPO'd in 2004. And it IPO'd at a valuation of $23 billion. So over a relatively short period of time, 6 years, that grew to real scale, $23 billion. But since 2004 to today, that business has now grown to over $2.5 trillion in value. So by restricting ourselves to either just private or just public, we're missing out on the whole life cycle of these businesses. By being able to invest early into private, continue to hold at IPO, continue to hold beyond IPO, as James picked up earlier, we're able to benefit from the full life cycle value growth of investing into these businesses. With that, I'll hand back to Uzo.
Thank you. Next slide, please. Thank you. So people always ask us, why can't I just invest in a separate public equity fund and then a separate private equity fund and then create a public-private exposure myself? And we would say, well, yes, of course you can do that. But in doing so, we would argue that that would be a synthetic public-private exposure that would really miss the key need to have a centralized investment framework where you have the same people that are focused on all aspects of portfolio construction with a real consistency across the board. So yes, you may have invested in 2 different portfolios, one public, one private, but overall, you may not be achieving the best in terms of sector diversification. And then the second point here is that this centralized investment team can really think about portfolio construction in a way that seeks to optimize investment returns. And then thirdly, to achieve a real consistency in active stewardship, which is really important. And then lastly, this centralized investment framework means that this single investment team can pick the best companies, whether or not those companies are private or public, with no restrictions in the investable universe. And we think that's really, really important. So over the next few slides, we're going to talk in a little bit more detail about some of these points, but I'll hand over to Paul for the meantime. Paul?
Thanks, Uzo. So this slide here just picks up on the performance over the last decade of different asset classes. We've picked out venture capital, private equity, and then the MSCI World Public Equities indices. And as you can see, the performance of private equity and venture capital has been very strong. So it would make perfect sense that having a combination of blending private equity into a public equity fund can enhance the returns that are possible from such a strategy. The reason for doing that, or the reason that we can achieve these returns in private equity and venture capital, is because we're able to access companies earlier, prior to their real value growth. We're able to transform those businesses by injecting capital that can support them in further M&A, help them to scale up, professionalize some of those businesses, and thereby increase the scale of those organizations such that their valuations can increase over that period of time as well. So I'll hand back to Uzo on that final point.
Yeah, and then just this final point, in terms of the financial benefits to the investor. So for those of you that on the call that may not be familiar with how the IPO process works in the UK, so typically when a company wants to IPO, the brokers and the management teams will try to build the book or build the shareholder register of investors that they want, so that involves giving some investors larger allocations than others. And by allocations, I'm talking about shares. So at Schroders, we're quite lucky in that, given our reputation and our scale, that we usually do get good allocations as companies want to have us as shareholders. But for smaller investment firms, or at times when even we didn't get a chance to meet the company at the IPO roadshow, these allocations can be smaller than expected. But by getting to know a company and its management team whilst it is still private, if it does eventually IPO, then the relationship that you've built over the longer period can then help to maximize the allocation that is obtained at IPO, and then even follow-on equity raises after the company lists. Paul, over to you.
Thanks, Izzo. So if we flick to the next slide, perfect, then we can just pick up here on the information edge that we gain by having a combined approach here with public and private. So the first point here is the widening of investment perspectives. Clearly, the private equity team is able to talk to earlier stage businesses, see new innovators in certain industries, identify new opportunities and investment companies that we can support. But we can also gain a huge amount of insight by talking to the public markets teams that are already looking at businesses that may be more established in those industries. So we can get a sense of actually how is the market developing, how is the competition out there, how big are some of the incumbents, and what are the challenges that could really face these smaller private equity-backed businesses through their life cycle. And it works vice versa. So when the public markets team is looking at a new opportunity, they can come to us and we talk about what we've seen or what we are seeing in the private equity space, where innovators are coming along and where they're presenting potential challenges to the future, where they're potentially disrupting some of the more traditional industries that we've looked at historically. So it's a very symbiotic relationship between the public markets team and the private markets team to be able to share insights, gain perspectives, and then have a far better understanding of the investments when we look to make them.
And then another example where an information edge may be created is at IPO. So as a public market investor, I can tell you it's pretty frustrating that we only often see about 2 to 3 years of financial history when companies seek to IPO. Now, that's not really ideal when you're trying to judge a company and how it might fare over different economic and different market cycles. So in addition, from the point at which we meet them to when they list is often quite short. So again, this just isn't enough time. And actually, these are some of the reasons why many investors prefer not to do IPOs in the first place. But by meeting the company whilst it is still private, several months and even several years before it actually IPOs, or by staying very close to our private equity team who may have met them before, means that we can really get a sense as to how the company has performed and traded over a longer period of time. So to give an example of what I mean, let's just look at recent times. So last year, in 2021, saw a record number of companies looking to list in the UK. You know, we've all seen the headlines. I'm sure that some of you on the call may have written about them, but a number of these companies have received a pandemic boost, and you've seen off the charts 2-year compound annual growth rates that have really been flattered by COVID. But what you often didn't get to see was the growth rate pre-COVID. Now, since some of these companies have listed, again, some, I'm not talking about all of them, you have seen a moderation in the revenue growth lower than the guidance that they gave at IPO. And the implication for that is that you've had profit warnings and then ultimately their share prices have fallen. So we say all of this to say that seeing the financial shape of a company over a longer period of time is very, very critical to our investment decision making. And also I'll just add to this that so private equity investors typically see 5 years, 10 years worth of financial information. So again, there is a difference. Next slide, please. Thank you very much. And then finally, look, in an ideal world, we don't think that there should be any constraints as to where a company can invest in. The entire market should really be open to him or her. So to demonstrate what we mean, I'm just looking at the screen right here. If you take the UK equity market, for instance, so the technology sector makes up less than 2% of the overall market. And in fact, it was around 1.4% when we wrote the paper. And that's in comparison to about 30% for the US market. So we are really limited in terms of choice. So to gain exposure to the payment sector, for instance, I can tell you what most public market investors will do. I'm not saying that this is the right thing to do, but you'll end up making these relative valuation arguments of why public company that's a payment company A is better than public payment company B. But that doesn't mean that either of them is the best payment company operating in the UK. Rather, it might be payment company C or payment company D, which are both private companies with materially better competitive advantages. So sharing information about the insights that we see across the overall landscape can really steer us to invest in the best opportunity, regardless of whether or not the company has chosen to go public. I'll hand over to Paul for the next slide.
Thanks. There's also really, this is just bringing to life a few of the examples where we've been able to benefit from the widening of perspectives here. So Oxford Nanopore is a business that I'm sure a number of you are aware of, IPO'd last year, but this is a business that we've been invested into for a number of years now. So we've known the team, we've known the business, we've seen how it's developed, we've seen the challenges that it's faced, but we've also been close enough to see how the numbers have really developed over those historic years. And this insight and understanding and closeness to the team has really helped us in terms of where we are today, post-IPO, and future views that we think are obviously very positive with Oxford Nanopore going forward. But it's that long-standing view and relationship that's really helped us throughout that investment process.
And there was a company that was looking to IPO last summer called LendInvest. And for those of you on the call that may not have heard about it, it's a specialist buy-to-let mortgage lender that's really benefiting from some of the high street banks in the UK that are retracting away from the sector. So it's really taking up some of that capacity by integrating technology as part of its offering. So as part of our due diligence, we spoke to the private equity team, and that's because they had some experience in the space, but when the industry was much at a younger phase. So, years and years ago now. So we talked about the positives, we talked about the negatives from their experience, and we really looked at how the industry had evolved since then and how the company had proven and improved its concept since the private equity team had met them. And in being a multi-asset investment firm, not only were we able to speak to our private equity colleagues, but we also spoke to our private debt colleagues who understood the sector very, very well. So all of that, this gathering of knowledge and information on really a 360-degree basis led us to decide to participate in the IPO. And we think that this has created a competitive edge in our understanding of the sector and the business. Paul?
And just the final company on this slide is Graphcore, again, a company that I'm sure a number of you are aware of. This a next generation chip developer looking at applications in AI. Graphcore is a business that we have been following for the last 5 or 6 years. We were looking for the right time to actually make the investment, and so that came about over the last year or two. In terms of the process that we followed when investing into Graphcore, this is where we were able to really bring in the public markets team and get some additional insight in terms of due diligence from that team. They were able to help us out in terms of the overall market size, the competitors in the market, some of the big players in the market that exist already, and also deep dive into the tech to support the due diligence that we were doing from a private equity angle as well. So that brought about significantly increased information and insight, clearly in making the actual investment decision. But along with that, it was a real benefit to the company to have Schroders coming on board with a private equity team and the public markets team both involved in the process. Graphcore is considering an IPO in the next few years, and so it felt there was huge value to be gained by working with and hearing from the public markets team to see what sort of levels of governance might be required in the future, what sort of key elements they need to be thinking about if they're considering an IPO in the future. So The benefit that that gave us was that actually Graphcore was much more inclined to allow Schroders to have a bigger ticket in the funding round than might ordinarily have been the case, because it can see how much value can be added over time, both as a private equity investor, but then longer term as a potential IPO supporter and a public markets investor in the longer term as well. So if we maybe flick through to the next slide, a couple of key points just to make here in terms of why we believe Schroders is well positioned in this industry. The first point here is that not all companies go on to IPO, and this is a pretty critical point. We've seen a number of players in the marketplace that focus very much on crossover investing. So if they can see a private equity opportunity, that they see it with a pure view of exiting to an IPO. Now that is clearly one route to realization of value, but it's not the only route. So we would be looking at a three-pronged approach that we talk about here. The first approach is to be looking at private equity companies that could well go to sell to trade or sell to further financial sponsors, so larger private equity firms in the future. Now that's a massively increased universe, and actually 90% of private equity investments, over 90% of private equity investments, end up being sold on to further private equity or to trade sales. So only 10% of private equity investments actually go on to IPO. Now, the crossover rounds, the investing into private equity backed companies that will ultimately go on to IPO is still absolutely vital strategy, and so that very much forms another part of the leg. But at the same time, we have the ability of the public markets team to be able to make their standalone investments into already quoted public companies. So we have these three different angles that we can pursue. And Uz will pick up on some of the difficulties around crossover in the future as well. In terms of the private equity deal sourcing, this again is a real standout capability that we have in Schroders. As James touched on right at the start, Schroders only acquired the private equity team, excuse me, over the last 4 or 5 years. But the private equity business that was acquired has been running for the last 25 years and actually put a huge number of the private equity managers, the GPs, into business over that period of time. Now, as such, that means that we've got really close relationships with over 400 GPs around the world, and having almost backed them in their first funds in a number of different occasions, that's created a deep-seated and close relationship with them and some loyalty there as well. And what that means is that when these private equity firms, GPs, are seeing new opportunities to be investing into, they often find businesses that are too big for their specific fund and that they look to co-invest alongside or get someone else to come in and support the funding round with them. And Schroders becomes that first point of call, given that relationship, given the history that we've built up with these GPs. So accessing really unique, access restricted private equity opportunities is something that really stands in our stead. I'll hand over to Uzo.
And thanks, Paul. So, and whilst there has been a lot of focus on crossover investing, particularly in the UK within the public-private space, we are not wholly restricted to crossover opportunities, as Paul just mentioned. But by crossover, we mean the private funding round that just precedes the IPO. So this can be 6 months or 18 months before the IPO. What we do also invest in is investing across the life cycle, as we have described. So investing at multiple stages of a company's life, from when it's private all the way up to IPO and beyond. And this really is our USP and where we think that we are different from peers. And just on this final point, ESG is really an area that we take very, very, very seriously at Schroders. So in relation to the G, so the governance aspect, we are scaling our public-private investment business with a focus on a team-based, collaborative approach where diversity of thought is encouraged and is welcomed, and all of this obviously serves to reduce key person risk. So that's a key differentiator.
Brilliant. I'll just pick up on this one. So this slide really tries to show exactly the universe that we've been talking about, and it shows where we're able to access a wide range of opportunities: public, private, venture, growth, buyout. So the whole gamut of what's available to invest into in terms of the investable universe. So what we can access is signaled here with the green dotted line. As we say, it covers off the later venture stages. So it's not the first stages necessarily of a business's life, but the later venture stages. all the growth stages, and then the buyout stage up to sort of small mid-cap buyout is typically where we would look to operate. We've also circled here or boxed here the crossover investing space, which again is very much part of what we can invest into. But as you can see here, it's a very small part of the overall investable universe that we can access, and clearly public equity here as well. So if I maybe just pass on to the final slide, this is really just a quick summary of the two teams that we have together, albeit that we're working very collaboratively going forward. So across the top, you have some of the stats on the private equity teams, over £9 billion of assets under management. We have over 50 investment professionals based around the world. So we've got teams that are investing throughout the US, UK, Europe, and then across Asia as well. And as touched upon slightly earlier, this refers to the network of over 400 GP relationships that we have globally. We're investing, as I say, from venture into growth into buyout, and we have no restrictions in terms of our global opportunities as well. I'll maybe just touch back to Uzo on the publics.
Yeah, thanks, Paul. And I think, as James mentioned earlier, Schroders' origins in asset management has really been in public equities. And this shows up in the scale of our public equity business, which is about £212 billion under management. Secondly, we are well resourced with more than 180 fund managers and analysts globally. And then finally, to complement the network and the access to companies that the private equity team have, we see many companies a year. So for instance, last year we held more than 7,000 company meetings across the globe. So we think that this is a really strong platform that allows us to create a very competitive public-private equity franchise.
Brilliant. I guess with that, we should hand back to James.
Thanks, Paul. Thanks, Uzo. Thanks, everyone, for sending in your questions. If you do have a question that comes up as we go through the Q&A, then do send it in and I will ask Uzo or Paul. So the first question that's come in, Paul, I'll address this one to you. You've spoken a lot about sort of the combination of public and private equity in a portfolio, but one of our listeners here has just pointed out that there has been some relatively high profile issues around sort of liquidity management in sort of including public and private equity into the same portfolio. Could you just comment on how you think about liquidity management in the portfolio?
Yeah, I think obviously care needs to be taken, but I think the important thing is coming up with structures that don't put the strategy under too much risk. So open-ended structures where you might have significant redemptions, and then that leaves you exposed to very high levels of private equity, are not really suitable to this strategy. So it's much more suitable to investment trust type structures where it's closed-ended.
Thanks, Paul. Thanks, Paul. Another question that's come through is one around how. So Uzo, you mentioned about the informational advantages that you're finding in terms of assessing IPOs as they come to market. One of the questions here is just around the potential for material non-public information and transfer there. Are there Chinese walls in place? Is that something? How do you manage that conflict? Paul or Uzo, either of you can take that, I guess.
Yeah, I'll maybe pick up on that one.
Yeah.
So generally, when we're working with private companies and they're considering an IPO, there'll be a shutdown of information that flows between that company and us as the private equity manager that's maybe got the investment there. So actually, it's very rare that we come into access to material non-public information. If we do, we obviously have processes in place to make sure that that's very well guarded and locked off and restricted. And so it's obviously, as you can imagine, from a Schroders perspective, it would be very well taken care of. But like I say, it happens rarely because we tend to go into a sort of dark closed period for a good window prior to an IPO actually happening.
Great, makes sense, Paul. Sorry, Paul, I'm just going to stay with you, Uzo. There are some questions for you actually, which I'll come to shortly. But Paul, this one's sort of more on the private side. One of our listeners has asked: Is there a time period that may be considered too long with regards to the business staying private that may force Schroders to change strategy?
No, I don't think so. I think if the business is continuing to operate and deliver and build in terms of value, then I think we can be very comfortable with it being a private company. I think that's the luxury of the sort of structure that we're trying to create here, is that we don't we don't look to force companies to IPO. There's nothing that requires us to force companies to IPO at any point in time. So, I mean, as long as that it's right for the company, then we're happy for our business to continue to be private.
Great, thanks, Paul. Uzo, now coming to you. So we've had a question here on one of the points you made around the optimization of returns by including private equity into a public equity investment portfolio. I guess you've covered off the returns angle quite nicely, and there was a good chart you showed in the deck, but how does it look from a risk management perspective? Clearly, we're going to include, well, it looks like we're broadening, have an ability to broaden out sectors, have different types of allocation, but how do you manage that risk?
Yeah, I think it's a really good question. We should probably try to define what we mean about risk. So if you take two companies, one is public, one is private, but all else being equal, they look the same. So they've got the same revenue growth, they're in the same industry, same suppliers, and so on. There really shouldn't be a change in the business risk, or you shouldn't be taking more or less investment risk. So we wouldn't say that that was an issue, but what you do get by including private equity into a public equity portfolio is you do get a reduction, or you should get a reduction in the price volatility risk. And that's because public equities tend to be priced less frequently than public markets. Obviously, you get daily pricing, etc. So, for instance, in our business, we only value our public assets around every 3 months. So, again, it's just about trying to make that distinction.
Thanks, Uzo. Just to follow up on that question, there's a question that's come in here around sort of the allocation of capital between public and private. Clearly, you're both proactively looking at your own size, but how do you work together to, and I guess this goes to risk again, to think about the allocation that is applied into the public side and into the private side? Is there competition? How do you resolve that?
So I think that it would depend on the fund. So for the different funds in which we have, the prospectus will define the optimal allocation that, or the optimal target that needs to be made. But this is really a competition for capital also at the very same time. We're looking for the best opportunities. So whilst yes, we do have a target in mind, but it really is about trying to seek the best opportunities regardless of whether it's public or private. Yeah,
great. Thanks, Uzo. And we have a question here on you mentioned ESG. There's just a question that's asked, do you have one overarching view on ESG, or is it slightly different on the public and private side? I imagine it is, as they'll be both developed to a different degree in the ESG credentials, depending on whether they're a private or public company. But could you just expand on how you both think about it on the respective sides, and then as an umbrella function, is there a consideration of that?
Yeah, another good question. Maybe I'll start off and Paul can fill in the gaps. So the first thing is to say is that at least on the public equity side, Schroders came out with something early last year to say that we're fully integrated ESG across our entire portfolios. And then we do have a central resource on the public-private team that does just try to make sure that there's a coordination between ESG on both sides. Paul, do you want to say anything else?
Yeah, no, I think ESG is becoming increasingly important across both public and private, obviously. So we have really developed our approach to ESG in terms of the frameworks that we're adopting here, and where we are. So private equity does generally have an approach that it takes, and there's a lot around SDG alignment, but there's whole frameworks that have been really detailed projects that have gone in place to ensure we have a really high quality process in place there. But that's on the standalone element. When we're looking at a combined public-private portfolio, then we'll be working very closely to try and ensure that we've got a very consistent approach between the two teams. So when we're having our weekly meetings and we're having our weekly discussions to talk about new investment opportunities, ESG will instantly be discussed as part of that assessment to make sure that we're both very much aligned in terms of the approach that we're taking there.
And how does that work in practice, Paul? Are you looking at SDGs? I know there's some proprietary tools at Schroders that you're using.
Yeah, there's a variety of different ways, and it depends a little bit on the actual product that we're talking about, on the fund that we're talking about. So some will be very closely aligned to the SDGs, and actually we think the SDGs are a great tool to be ensuring broad ESG alignment. But there's some that are a bit more specific, and we're talking from a European perspective about Article 8, Article 9 type funds, and some of those have even greater impact requirements around them. So there's quite a wealth of knowledge, process, framework, and it can depend to some extent on the product that we're talking about.
Fantastic. That's all the questions we've actually had come through. So I mean, if there are any final questions, please do send them through now, and I can ask the team. But otherwise, thank you very much for watching the presentation. Thank you very much also for sending in your questions. We really appreciate you spending the time, and I'll pass you back to Michael.
Yeah. Thank you everyone for attending. It's really appreciated. And thanks again to Paul, Uzo, and James for a very informative presentation discussion. If there are any questions, do get in contact with Schroders. And thank you everyone for attending, and goodbye.